Bring that ass back like a boom, 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 boom.
Hello guys, Supernova here from Boom Traders with the second video of the risk versus reward short series, and in this video we're going to be talking exclusively options. Now, in the previous video I noted that when you're trading stocks, forex, crypto or futures, you're basically using some technical setup or a fixed amount of your account equity to define your risk. Now with options we go a bit further, so we are adding an additional layer, and it's by definition the result of the way that options do work. So I'm not going to go into detail what options are. I'm not going to be talking about what calls, puts, different spreads are. This is for another educational video. But what I want you to show, what I want you to know, and I want to show you is how you can even further enhance the risk that you are partaking, and be absolutely sure that you're not going to be losing more than this 1.1 to 1.5% per trade of your account equity. Now, let's just pick a chart, and in this case this one is the S&P 500, but let's just go for the LTR. That's a recent stock that I've traded, and I got stopped out on the first breakout of them, and the second one I closed on Friday afternoon because the market was dropping. Yes, the LTR is behaving pretty well, but with this market conditions I don't want to have overnight risk, and especially with this long 3-day weekend. So this is the LTR, dollar trade. The way we trade breakouts usually, and I'll speak about some some complicated ways that you can trade options, but we'll take first the most basic examples with buying calls and puts. So the way I trade breakouts is I buy on a breakout of a certain range, and I place my stop loss either on the candle that is prior to breakout, so the low of the prior candle, or below a support zone that is nearby, whether it's a base, whether it's a triangle formation, whether it's cup and handle, which is also a type of a base. So no matter what it is, there is a stop loss. And in the previous video I mentioned I usually like to go for stop losses that are between 2 and 4% on a trade, or again, absolute stone rule, no more than 1% of my account equity. So the way I trade the LTR on Friday, and I also closed it on Friday because it was, as I said, a very interesting day, is we are having like this pattern here, which is a cup and handle. So this is the cup formation, this is the left side, this is like flat base, a cup, this is the little handle, and we're breaking out of the handle. Now you can either trade it on the breakout of this high right here, or the breakout as I did on the sloping downward going trend on this couple of days. So I traded this breakout right here on this candle, like 137. I placed my stop loss on 133, which is $4, and I closed at the end of the day about 141.5. So it's a one-to-one trade. I probably should have not jumped at all in the trade, knowing what Friday was like, but I was to a certain degree expecting a bounce later in the afternoon, and we didn't get that, and that was the reason I closed it. Anyways, so if you buy the stock right here at 137 and hold it overnight, and on Tuesday we open with a gap down, like for example, look at right here, there were no earnings for a couple of days later, so we opened up with a gap up. But if you're holding a short position here, you are basically screwed. So with these market conditions, we might get, you know, a gap down below my stop loss level, and there is absolutely nothing that I can do. Not to even mention that this gap right here is not filled. So if we gap down, to fill this gap, we're looking at a very serious stop loss, because I've risked 137 to 133. I risked $4, and from 133 to filling that gap to 115, this is like almost $20. So this is going to be huge loss for me, and this is what stocks can do, and they do it from time to time. This is why I also advised in the chat room that you never go full buy on the first buy of any position. So I usually go half, and then I add on to my position on another technical level. Now, if we take a look at the option chain, and this is Tasty Works, this is DLTR, this is how all the strikes look like, and let's say just if we go in 30 days out, so these options will expire in 27 days. Now, we have earnings, and it's showing for 2nd of March, so no way we're going with options. But let's just in case you say these earnings were not here, the IV rank was 25, 30 or below, and we decide to go with options. What would we do is very basically buy the 140 strike call for $950. What that means is that even if price gaps down here, I cannot lose more than $950. Heck, even if price of the LDR goes to zero, I will only lose $950. Now, you might be wondering, this says $950, but here's $950. Well, remember that this is the price of the contract, but the price of the contract is for one share, and each contract has 100 shares by definition. So basically, we're looking at 9.5 times 100, which is $950. Now, this is the absolute basic way to utilize options. You're buying a call, or on the other side, you're buying a put. That means that you're betting that the price will go down. And in this case, the maximum amount of money that you can lose is the premium that you are paying to get into this contract. So basically, you don't own anything in terms of shares. You're basically buying an agreement with the market maker that you're willing to pay $655 in this case for the right to purchase the options, the stock at a later date. That's it. It's a bet. You don't have the stock, neither with puts or calls. You just pay a contract premium. And at a later date, if the price of the underlying asset, as they call it in this case, the price of the LTR, is above $140 in 27 days, you will be able to acquire 100 shares of the LTR at a price of $140. Now, in 27 days, the price of the LTR might be $200, but because you spent $950 on this contract right here, you're entitled to buy 100 shares of the LTR at the price of $140. Then you can flip it right away for $200, and you'll be making massive profit. This is what options are. But this $950 right now is the maximum amount of money that you can lose because you don't own anything. So this is an additional way to limit your risk. However, now there is certain aspects that you have to think about. So let's just pick, cancel this, let's just pick a stock that is higher priced. So example, let's look at Google. Google, yep. So let's look at Google. Google is currently priced at $2,608. And let's just bring Google here as well. So this is the chart of Google. Let's just say, for sake of argument, and I'm looking at places where I could have bought, and all right, let's just bring the chart right here. So let's just look at Google right here. So Google is forming like a base. We have this resistance on top, right? We have this resistance on top. We have a gap down here. We have some lower wicks. Just assume that this is our support. Google tried to rally, hit this resistance, faded, made new lows right here, formed another line of support, gapped down on the open, closed above it. So you can initiate a position right here because we are gapping down and then filling this gap right away, moving above this prior resistance, now support zone. It was support here, we made it resistance, we trapped some short sellers probably here, closed above them, they had to cover, so the next day is a positive day. And if you are a pure breakout trader, you will be buying on the breakout of this level right here, and you'll be placing your stop loss right here. Exactly. However, now if you're thinking you can risk a maximum of 1% of your account equity and you're trading $100,000, so you can maximally lose $1,000. All right, let's just measure that. See, move just one candle more. Okay, so you're either buying on the breakout if you're following the market, or you're buying here and placing your stop loss right here. So let's do this. You don't have the time to watch the market all day. You are risking three, as you can see in the blue rectangle up there, you're risking 3.84% if you place your stop loss right here on the low of this candle. Okay, let's just make it 4% to be too easier. So you're risking from here, from the close of this to the low of this candle, you're risking about 4%. Now 4% of $280 is, just bring the calculator because this is how cool I am, of 240. It's $112, and we said you can lose a maximum of $1,000. So an easy way is divide this by 112, and you know that you can buy approximately 9 shares, 8.9. So you buy 9 shares of Google, right? And the maximum that you'll be risking if your stop loss is hit is $1,000. You buy 9 shares of Google, which, if you are doing this times 280, it's an investment of $25,000. Surprise, surprise. Look at what we have right here. Boom, $25,000. So, if you're doing options on Google, you can buy one call for $10,040. Now this will entitle you to ownership in case you want it at the end of the expiration period, and let's say this is in the money. This will entitle you to 100 shares, but right now your maximum loss is $10,000. Can you afford that when you're with your $100,000 account? Or some might say yes, but the reality is the proper answer is no. So what you can do is you can create a spread, and in this case you will be limiting your upside, but you're also limiting your downside. And as you can see, most platforms like Tastyworks, Thinkorswim, TradeStation, Robinhood, Interactive Brokers, they will calculate this for you, your maximum loss. Now remember, you can lose a maximum of $1,000. So right now this spread is 1 contract each. What you can do is either bump up the number of contracts, so 4 contracts, $1,040 maximum loss, but you see maximum profit is $960. So if you keep shooting for trades like this with options, you'd have to be right more than 50% of the time. And we know that this is not very likely. What else you can do is, let's just clear that trade and construct another one, but this time I will be dragging this a little bit more. So I'm creating a wider spread, you see. My maximum loss is still $915. This will get a bit over 1,000. Okay, this will get a little bit over 1,000. But my max profit is still less than my maximum loss. So in this case, again, I have to be thinking of different strategies, because this means I'll have to be right more than 50% of the time. And if you know anything about options, there's the theta, which means that basically in this type of a trade, I'll be losing money every single day. $2.66 to be precise. I'll be losing that. No matter what happens, I'll be losing money. So, although you're limiting your risk to some point, you are also limiting your profit to a point. And in this sense, this trade is not really okay for you, because it can go either way. We are right here. It's the price of Google right now is $2,608, and you're selecting the 2,605 strike. And the movement of the stock, this is another thing that options platforms are doing for you sort of free. They're giving you plus minus 184 points in about 27 days. So this is the expected range. So from 2,608, the price is expected to go to about 280 or drop to about 2040. So 2,800, sorry, to about 2,400. So you see, this can go either way. Your probability of profit, another thing that I'll talk about in just a second, is about 45%. So this one is basically 50-50. It's a coin toss, and you have to keep trying on this. So you don't really have an edge right here, to put it mildly. What you can do is a different type of strategy, and then again you have to be doing your journaling to see how well you're doing. You can take advantage of time passage, and usually this is good to do when there's strong supports and strong resistances. So for example, what you can do, and let's just flip to spiders. So this is the S&P 500 chart. As you can see right here, we have some strong support, right? So what you can do when you see like a couple of candles stopping at this strong support, which is 426. Right now we are at 434. So we have a couple more points to move down here to support. So it hit once. Well, this one was a break, but then immediately followed by a very strong bullish candle. We touched it a couple of times. We tried to gap here to it and moved up. We did a couple of times touch it here and bounced again. Here we pierced it, went up. Next 4 sessions we were not able to catch it. So come price 426, 427, what you can do is place not soy but SPY. You can place a put credit spread, and the put credit spread will collect for you some premium. So 427, I'll make it 5 points wide, 422. Now here's the thing. The statistics of this trade, if the price was 427, will be similar to the statistics of this trade, because I'm doing it in the money. Well, at the money, not in the money. So an at the money put credit spread will give you $186 profit, but look at this, $314 of loss. Now, because options are pretty efficient in their pricing, you can expect to see a profit potential or probability of profit, called here POP, of about 50%. However, this is not the case right now. We are calculating based on implied volatility as some other factors that probability of profit is 48%, but you're risking $314 to make $186. So is this a good proposition for you? The answer is no. The way this works is that every single day you are gaining money on this spread. Now, in this case, we're having a negative theta, sorry, but usually put credit spreads are supposed to bring in money for you because you are selling credit. Now, the important thing I want you to understand here with options and whatever you're trading actually is that you need to keep your journaling. Most traders that are utilizing the power of put credit spreads and call credit spreads to collect money every single day are betting that prices will not drop below the support line. So basically, if you had a trade that looks like this, and you have a choice. You can either play the breakout or you make a put credit spread. And this put credit spread you select because this is support. Definitely this is support. You see, we go down, we make a nice wick, we gap up. This is support. Instead of buying here on the breakout of this candle, instead of buying here, right, you can just make a put credit spread 430 to 425, and this way you're betting that the price will not go below this. However, most traders that are doing put credit spreads or call credit spreads, they are counting on a higher accuracy percentage. So they can go for 70, 80, 90% correct trades. However, as you see with any put credit spreads, 120, okay, 425, 420, you're risking more than you're gaining. And in this case, you're risking more than 2 to 1. So you need to be higher in your accuracy. I'm not saying that this is not a trade that would work. It might work, but this is not what I like. However, this is an option that you can exploit further. As you can see, with this type of trade, we're collecting 23 cents every day for the passage of time in our favor. But we're risking more to make less. With this type of trades, you have to be right very high percentage of time. Whether you will choose this way or you will choose any other way to trade options, you can just buy a, let's say you wanna say that the price is gonna go down, you can just buy a put. Then if you're buying a put, this is the maximum amount of money that you're risking. This is the maximum profit in case buy goes to zero, which of course will not happen, but you never know. So options will always calculate your maximum loss, and it's up to you to computate whether the maximum loss is within the 1 to 1.5% of your account equity. Now you can exit an option spread or an options position prior to expiration at the profit or the loss. Some traders are doing that. Some traders on the breakout here will just buy the call and place a stop loss if price of the underlying, which is the S&P 500 in this case, goes below this stop. You can do that. There's nothing wrong with it. Just know that even if the price gaps down, your purchase is limited, your risk is limited to the amount of premium that you paid or to the maximum loss on the amount of premium that you sold. And this will be calculated for you in your platform. Some people will go for 50% loss of the premium, some people will go for 25% loss of the premium, some people, like what I prefer if I'm trading options, is to go for 100% of loss of the premium on the options because you have no control of the market. So this is the second video of the risk versus reward. Now I know this is a bit more complicated, and if you guys, as I said in the previous video, if you guys need any help, we can do some additional live video tutoring in the Discord channels. I'm there pretty much all the time, so we can talk about it, and I can go into further details explaining options and how to structure trades. Tintin and Teds are experts on options as I trade more stocks. But I'll be happy to help as well. So if you guys need anything, please let me know in the Discord channel, and I hope this was really helpful. Again, don't forget, you need to master your setup, you need to do the math, and you need to keep journaling. Okay guys, I'll see you soon, or I'll see you on Tuesday in the chat room. Thank you very much, and have a very, very nice long weekend. See you. Bye bye.